Welcome to the latest film from Currency.com, where we cover everything to do with crypto. Remember to like, comment, and subscribe. In this film, fellow Currency.com analyst John Doe,
oh hey Tom, what's up?
And myself introduce you to fundamental crypto analysis and how it works.
Time for me to jump in with a word of warning. Crypto analysis, just like all other investment analysis, is not an exact science or guaranteed against losses, but it will give you more knowledge to make those better decisions.
Thanks for the risk warning, John. And a little note from me, crypto analysis is complicated and takes time and practice to master. But don't let that stop you getting stuck in. Time to buckle up and enjoy the ride. Fundamental analysis is all about trying to establish the intrinsic value of an asset. And if it was easy, we'd all be very rich.
No doubt, Tom, we certainly would.
Traditionally, fundamental analysis has meant looking at things like a company's revenues, profits, costs, capital structure, and comparing them to industry peers and competitors. But in the entirely new and emerging crypto market, most of that data doesn't exist. That doesn't mean fundamental analysis doesn't work for crypto though. It just means we need to look at different metrics. Market cap is basically the total value of a cryptocurrency's available coins. Coins with a low market cap are generally in the early stages of development and have greater potential to deliver sky-high profits as they grow. Who doesn't like the sound of that? But be warned, they're also usually volatile and there's a higher risk you could lose your entire investment. Looking at a few recent examples of low market cap coins, you can see big gains, but also how volatile they can be. In contrast, high cap assets like Bitcoin and Ethereum are generally more stable, but offer smaller percentage gains. Then there's liquidity, which is a measure of how easily a coin can be bought or sold. Trading volume is a key indicator of liquidity. If few people are buying or selling, then the trading volume is low.
Then we've got project metrics. These are all about qualitative approach and can be broken down into 4 areas, all of which are easily available and very useful. A crypto's white paper is a technical document from the developers that is publicly available and gives an overview of the project from its purpose to its technology, its roadmap, and its goals. As a potential investor, you want to know, is the white paper comprehensive and informative? Or does it sound unrealistic and too good to be true? Then there's who is involved in the project? Do they have the required expertise and a track record of successful ventures? And then it's useful to look at how does the crypto project you're looking to invest in compare to its competitors? If it's already a crowded market and competing projects are better, you might want to steer clear. And finally,
today I want to talk to you about the future of tokenomics.
Tokenomics is a hugely important metric in crypto fundamental analysis. It's basically the words token and economics added together. And then it's all about the distribution and the future supply of a particular token.
Looking at how a crypto is distributed can alert you to potential risks. If a large majority of the supply is owned by only a few parties, or whales as they're known, the coin might be susceptible to future market manipulation. Insight into the future scarcity of a crypto asset will tell you whether it's deflationary or inflationary. And basic economics tells us that scarce assets with rising demand pushes up prices.
An example of good tokenomics is Ethereum, with its simple and understandable model and widespread ownership. Adding in the burning of over $7 billion worth of ETH coins in order to limit supply, it paves the way for Ethereum to be deflationary. And with its obvious utility, it's easy to see why it's appealing to investors. And examples of bad tokenomics can be found throughout the crypto world.
Right, that's our guide to fundamental analysis covered. Just a reminder for you all, we can't say enough that crypto analysis is not an exact science. It does not guarantee profit or guarantee against losses. Practice is everything when it comes to analysis. The more you do it, the easier it becomes, so stick at it.
Wait. Hold up, Tom. We're not quite finished with our guide yet, though. As well as fundamental analysis, there are some other indicators that are also useful to keep an eye on if you're thinking of diving into crypto. Global events like the war in Ukraine, government regulation, as was seen with China's ban of Bitcoin mining in 2021, which was a catalyst for a dip in the price of Bitcoin. And regular economics events like recessions, inflation, and changes in interest rates. All these factors can affect cryptocurrencies, so it's important to take them into account.
And then there's social media. Unsurprisingly, in the decentralized digital world of crypto, social media can be an enormously useful tool and guide of sentiment and potential movement of cryptocurrencies. Whether it's Elon Musk tweeting about his beloved Dogecoin pumping the price up 20%, conversations among retail investors on Reddit, or core decision makers and whale investors revealing their strategies, social media can give vital insight. But beware, timing is everything, and lots of hype can actually be an indicator you've already missed the boat.
That's our guide to fundamental crypto analysis. Remember, there's no guarantees, but by utilizing analysis, you'll have the tools to make better decisions. Good luck trading.
Thanks for watching, and if you want to learn more about crypto analysis, check out our other films on technical and on-chain analysis.